All right, welcome to the global macro update, traders. We're going to be going over quite a bit of stuff here, looking at debt levels, understanding deflation, inflation, what causes it, the factors that make it difficult for prices to go up in value, and things that make it easy for prices to go up in value. And we're going to be looking at Japan because it's a really good example of the extremes that can be pushed for money printing, and we don't really see that much price increase or anything in that regard. So it's pretty interesting. All right, so let's get this going. We are now live on YouTube and TikTok, and just making sure we're going to get a few more people in before we jump right in. We do have a Discord in which we post when we are going to be doing our lives. We do them every day, sometimes in the morning, or most times in the morning, sometimes a little bit later in the afternoon, depending on what I have, depending on the markets and all that stuff. So let's get the recorder going and just jump right in. All right, let's get this guy here. Hey traders, welcome to another global macro update. We are going to be touching on crypto as well, so it'll be a mixture of crypto market update plus global macro update. Don't worry, we will put timestamps at the bottom of the description here, so you can flip to equities, stocks, oil, whatever you want to do, whatever you're looking to get another take on, you can just search it right at the bottom. So first things first, we're going to take a quick look at the total hash rate. So this is a visual representation of, in my opinion, the degree of difficulty in order to actually mine one BTC. So when the hash rate increases, there's more people joining the network in order to mine Bitcoin, which makes it more difficult to mine Bitcoin, which increases the electricity cost in order to produce and mine. So in order to see what's happening within the miners, this is a really good representation. We do see there's a lot of just sideways consolidation. And yes, we did have that before, kind of in this area, as well as before the huge dump in 2018 and the start of 2019 within that consolidation. But overall, we're really getting a whipsaw action from the miners and the total hash rate. We're not really able to make a new high, and we've made a lower low. So in terms of just looking at the hash rate, it's kind of stalling right now. Miners aren't coming onto the network, and there's some people leaving, some people joining. So the way I view this is, if we do get a quick move to the downside, I think there will be more miners that do need to leave the network. They'll probably sell their only asset that they make through the revenues, which is BTC, which is going to aggressively push the price down further if there is already momentum to the downside. Now, we have talked about a potential miner capitulation a little while back. Didn't really come into fruition, but the miners, if the price of BTC goes down, will get squeezed. This is not a matter of when, but it's not a matter of if, but when. It is inevitable at the end of the day. In my opinion, in terms of the BTC market miner capitulation, it's just a matter of when. And if the price does move down, I think we could see that come into fruition. And also, just talking about the correlation within the traditional assets like the S&P, the Russell 2000 is positively correlated with BTC, and you got to take that into consideration, although it is decreasing a little bit right now. So that's the hash rate. Little quick look on the futures market cap. So this is open interest, number of positions that are open, long versus short. And you can see on the 24-hour time, there's a little bit more of a long bias on these exchanges. Not by much, couple of percent on Binance, couple of percent on BitMEX, and really not much on Bybit. So overall, looks like traders are looking a little bit more bullish, making sense. Equities market are up, pretty decent bounce, risk on sentiment, it makes sense. And on the smaller time frame, significantly more longs than shorts. On Binance, 54%, really break even on BitMEX, and actually a little bit short on the smaller time frames on Bybit. But overall, a little bit longer bias, more neutral on these smaller time frames. And we'll get into the charts in a little bit here, looking at BTC. But for now, we're really going to try to discuss the idea of inflation, deflation. What is it? how countries get inflation or deflation, because a lot of people just assume if there's money printing, it's guaranteed to instantly cause inflation, and that's just not true. So I'm going to get a little bit of coffee, and then we'll dig right into this next article. All right, so the chairman of the Federal Reserve, Mr. Powell, has stated that there's no real worry of inflation. Consumer price inflation has dropped noticeably in recent months, and he said long-term inflation expectations have remained fairly steady. As output stabilizes and the recovery moves ahead, inflation should stabilize and gradually move back up over time. Inflation is nevertheless likely to remain below our objective for some time. They're still trying to push for that 2-3% inflation that they really like to have. They don't want deflation. They think that's the worst thing in the world. They think it's terrible. And too much inflation is obviously not good because the people in your country are just losing value. But in terms of the Federal Reserve's ideas, that's not necessarily a bad thing, because that's what they objectively try to create, is slow proliferation of currency. These slow, in my opinion, it's like stealing from the working class, because if they're putting their hard-working dollars in their savings account getting 0.1% interest and inflation's 2%, you're literally stealing their value every single year, and the people who are able to print the new money is getting all that power. So stealing from the rich, taking from the or stealing from the poor, giving it back to the rich, that's how the system is set up to be. So it's not a great system in terms of the current monetary system that we have in our society. So a lot of people are thinking this is total bullshit because we have so much more money being printed, there has to be inflation. Well, not necessarily, right? We can see that Japan has been printing way more money compared to the United States. This is the money stock, right? So this is the amount of money printed, index of billions of dollars of their national currency. And we can see that Japan is just way more aggressive in terms of their money printing compared to the United States. But you're thinking, whoa, how in the world can Japan have so much money printing and they're actually fighting deflation, meaning that the CPI numbers, the consumer price index, the rate at which the average cost of goods and services are going up and down, Japan's suffering it from going down, not up, even though they have all this money printing. And here is another look. It's a chart I created on the Fred website. This is central bank assets to GDP for the United States, which is in blue, and Japan, which is in red. And we can see that Japan is over 70%, 73% right now for the central bank assets to GDP, which is pretty crazy. America sitting nothing close, is like 21.7% compared to Japan. So we can see central banks can print a tremendous amount of money and purchase assets, do quantitative easing. In Japan, it's quantitative and qualitative easing. Basically the same thing, printing money, purchasing assets, trying to create aggregate demand through the proliferation of currency. That is what they're doing. It basically, central banks have one single thing that they can do as a tool. They don't have much else. They can lower interest rates, which they can't really do at this point because Japan has negative rates and America currently has zero in terms of federal funds rates. So what can they do to try to increase and stimulate demand? Well, they try to print money and purchase assets, right? Financial assets. Or just literally send it to people, which America did for a little bit there. But we can see, central banks can do a lot more than what America is doing right now. So we can see with all this money printing, with all this aggregate demand being created, you would think that inflation would be pretty crazy in Japan because they're printing a lot of money. But Japan is actually fighting deflation, meaning that the CPI number year over year, the consumer price index, is actually negative. And we can see it's more negative than positive for most of the time. All of the 2000s negative, little bit of a bump in 2000 and let's say 5, and then 7, big spike up, kind of at the financial crisis. But overall, we're getting on average negative CPI numbers or consumer price index numbers. So why in the world is this? How can Japan print so much money, yet they're fighting deflation? They're fighting prices of goods and services going down for the past, handful of decades here. Since 1989, that is when they're right around here. That is when their asset bubble burst. Kind of like the financial crash in 2008 for the United States, just to some degree, except it got reinflated, and Japan just could not reinflate. This is something I found that was pretty cool, accounting for the decline in the velocity of money in the Japanese economy. So this is a major part of why there isn't any inflation in Japan, is the fact that they have a significantly downward momentum in the velocity of the currency, the Japanese yen. And we can see why is that the case. I highlighted a pretty important section in the abstract here. Particularly important is the channel stemming from households' expectation about the future liquidity requirement. During the Japanese banking crisis and the global financial crisis, credit service is disrupted, and households expect a disruption to last long. Since they demand additional money for the higher liquidity requirements for the current and future transactions, the velocity and the price level decreases, even though the growth rate of the money stock then exceeds that of consumption. So in layman's terms, put it simply, people are worried that they don't have enough money in case of emergencies. Liquidity is just having enough cash that you can easily use to purchase everyday goods and services. If you have liquid assets, they're going to be like a house. If you have liquid assets, it's going to be things like cash. Things that you can sell quickly to turn into exchangeable asset like Japanese yen, USD, all that stuff. So the worry after a financial crash is, oh shit, I don't have enough money to pay for next month's rent, food, whatever bills you have, mortgage. So they're going to save more than a consumer type of economy where you don't have to save. You just have to put it on credit. You just got to pay off the minimum balances, keep on consuming. That's kind of how America is. They're not savers. They are huge consumers. And this is inflationary. But if an entire demographic is shifted to a saving type of mentality, this is extremely deflationary because the velocity of money is decreasing substantially. There is less currency that is transacted within an economy, which is going to decrease the inflationary rate. It's going to create more strength for the currency. And here is a comparison for the CPI numbers, Japan versus the United States. So let's just zoom it in here so we don't have that big spike. 1989, right around there, was the asset bubble crash in Japan. And we can see Japan in red. Very, very low inflation compared to the United States. Ideally, central banks are looking for like 2-3% on average in terms of inflation, but Japan is struggling to get that, even though they are printing so much money. And this is what is kind of hard to grasp for a lot of people. A lot of people instantly think money printing equates to, oh shit, there is cause for inflation. Prices of goods and services are going up exponentially. That's not the case. You need to have the velocity of money increase along with an increasing pool of currency in an economy. That is the catalyst for increasing CPI numbers, increasing prices of goods and services, and that will create inflation worry for the general population, which then makes sense for people to look for safe haven assets like gold, like silver, like Bitcoin, and other fixed supply instruments that allow for some level of safe haven characteristics while the currency is devaluing substantially and central banks are debasing the currency. But overall, we do see Japan's struggling to create any sort of inflation. So when people say, oh my god, we're going into a hyperinflation right away, I just do not think that is the case. There's so much deflationary pressure put on the United States and really major countries around the globe. First thing's demographic. America is around 10 years younger than Japan, and another thing is just the saving mentality. Currently, the consumer confidence is pretty strong for for America, but if the consumer starts to lose confidence and starts to save more than they spend, America could turn into something like Japan, where they're really struggling to get inflation. And this is the demographics of Japan. We see back in 1950s, huge demographic for the younger side, which is great for inflation. New young adults are getting their first car, couch, clothing, house, cell phone, whatever you buy when you are becoming of age to move out, purchase a car, purchasing a nicer car, all that stuff, that is inflationary for an economy. There is increasing numbers of people purchasing things that is going to drive up the price of those assets. Increasing demand, fixed amount of supply, prices of assets go up. It's pretty simple. And then you have when the economy is at the peak, when you have the largest amount of people within the working class, you have the highest output, and then this is where Japan is kind of post that is you have a deflationary spiral where there is a larger amount of people on the higher end of the age group and not that many people driving demand in the lower section. So this is deflationary. More people are selling things. People have 2-3 houses and they're renting them out, and they want to go travel. They want to live a luxurious retirement, and they want to sell those assets like real estate, and they want to sell some of the stocks that they've been accumulating over time in order to generate liquidity for them to, go have an operation, buy their son something nice, or whatever the case may be. That's deflationary. The older generation is deflationary. The younger generation is inflationary. So if you have an older generation that is exceedingly larger than the younger generation, that is a deflationary push. And on the contrary, if you have a younger generation that is significantly larger than the older generation, that is an inflationary push. So we see things like Singapore have very strong inflationary demographics. So the younger generation in the 20s to 35, 40s, this is the largest demographic in Singapore. So you're going to see higher CPI numbers. CPI is going to be easier to get positive. You're going to see 2-3% CPI numbers on a constant year-over-year basis for Singapore that is easily attainable compared to Japan or even America, where the demographics are going to be really pushing on people trying to save, people trying to sell things, because that's just a demographic. And then this is the United States right here, U.S. population by age and sex in 2017. We do see it's not terrible, but there is definitely less people coming in and being born to facilitate the growth for kind of the next generation after the baby boom generation. We see that this is the big baby boom demographic kind of in retiring mode, and then we see that their kids right here are filling up the next spot for the demand and trying to create that demand for the next generation. Although we do know for a fact that the baby boomers have the majority of the wealth. They basically had the best time to invest in stocks. They had the best time to invest in real estate. It was a huge boom their entire life, really, if you think about it. They had the best time. They had the .com area, which was absolutely insane. They had the real estate boom. And they were able to collect a tremendous amount of assets. Well, the generation after them, they really didn't get anything. They got right into the .com bust or 2008 bust. And they weren't really able to collect as many assets. Unless you are savvy, entrepreneur, business owner, you're able to do it. But if you're just go to university, get a degree, work for someone for the next 40 years, it's really hard to climb up the ladder at that point in time. So that's the overall analysis. I do think that the United States will have difficulty being able to achieve their desired inflation rate of 2.5, 3%, whatever it is around there, 2-3% is their desired inflation rate. I do think it will be difficult for them to actually try to attain that. And I think it'll be somewhat similar to what Japan is facing, where they'll try to create aggregate demand, they'll try to create stimulus through the proliferation of currency, printing money, devaluing it, debasing it, and it just won't work. I don't think it'll work. And way later down the line, this is like way macro, I do think that when there is a generation that is going to increase the velocity of currency, or if there's just a point in time where there's a loss of confidence in a currency, that is when there's a huge shift. Because when you see a dollar and you think this is going to be something I save, when you have from that idea into, okay, I know this dollar is going to be losing value as time goes on. I want to spend this dollar and buy a thing that is tangible. I want to buy an apple because I can eat it. I want to buy a TV because it's going to give me entertainment. I want to buy a car because it's going to give me transportation. Whatever it is, people are going to opt to purchase that item sooner because they know that the value of the currency is going to drop and they're going to need more units of the dollar, the yen, the Canadian dollar, Australian dollar, whatever it is in order to buy that asset. So there's going to be a shift when people are going to be buying assets sooner because they understand the depreciating value of currencies. And at that point, I think that is when the velocity will shift. More people will want to purchase that item because they know that the value of the currency is devaluing. And you're going to get a huge loss in confidence. You're going to get the velocity of currency to go much higher because of the worry that if you hold a lot of currency, it's going to devalue. People will finally start to understand. And that is when you start to see major inflation and even potentially hyperinflation, because you have the massively increasing pool of currency we can see right here. So you already have one item in the formula complete. You need two things, right? You need a significant increase in the pool of currency right here, M2 money stock for Japan and the United States. We already have that. The only thing that we need in order to see inflation, hyperinflation, is going to be an increase in velocity. And in order to see that, I think you need to see a loss of confidence in currencies altogether. Because I don't think that there's going to be a huge demand shock and we're going to have something like the roaring 20s where people are buying assets left, right, and center. There's never enough to go around, and it's a huge boom. I think the loss of confidence in currency is a higher probability than us going into a massive economic boom where demand is surging. I just don't see it coming anytime soon, but obviously this is just a speculation. So that's on the really large time frame kind of macro scope of things, but I don't think that's going to be happening anytime soon in terms of the huge demand for currencies overall. So that's a little bit more of the fundamentals. I'm going to get a little bit of coffee and then we'll jump right into equities markets and do a round for understanding the risk off and risk on sentiment. So I'm going to get a little bit of coffee and then let's jump right in. All right, so let's first look at the global equities. Vanguard, global equities, basically the entire world of equities in a single index. We can see this is the daily chart. Every candle represents a single day. And look at this candle. We gapped up significantly, which is bullish, obviously. Came back down. The wick bottom, so the low of the candle, just touched the previous candle open, immediately rejected, and got pushed right back up. This to me indicates a lot of buy pressure, pushing the price up. The bears tried to get the price back down, filling the gap, but the buyer said, no, I really want to get in. I'm willing to bid up the asks and take away all the asks and then push the price higher to get in. This is what happened. And we're seeing demand still continue to push the prices higher. And then we can see that within the S&P and Russell 2000 as well. So this is the S&P 500. We see a previous level of resistance and support. Let's just get our snip right here. We knew that this 2960 zone was a major level of demand because this previous zone was a 61.8 fib level, which was a key level of resistance, and once it broke, it made a strong move towards the upside, and we're going to assume that there's going to be some demand here because it was a previous level of support. That's exactly what happened, and we got a strong candle which indicated some buy pressure right here. We can see that on the daily as well. This is the 4-hour chart of the S&P. And then what do we see after? Initial resistance, new level of support, candle closure right there. This is a lower high. And let's just get rid of all this. And then now we made a higher high and higher low. So let's get our larger one just so it's easier to see. So we made an initial support turning into resistance, and this is our lower high. This is a high, this is a lower high. Low, lower low. So we're making lower lows and lower highs, holding our key zone, squeezing the price, making a decision either to the upside or downside. The market did make a choice to move to the upside, making a strong impulse push at the support here. Surprised that it broke this previous resistance, and now it's acting as a new level of support. And we see the 4-hour come down and get pushed right back up, almost closing at the top of the candle open for this current 4-hour candle. We got around 10 minutes left, but overall, we do see the buyers are really pushing the price up, validating this as a new level of support. So overall, the risk on sentiment still looks like it is looking strong. We did see a nice little squeeze right here, push to the upside, previous level of resistance right here, going to be acting as a new level of support. So it looks pretty bullish in my personal opinion, just in terms of the market structure. And I think we could see another pop up here in the continuation to the upside. Don't really see any real hesitation from the sellers just yet. We do have that key level around 32.30 we do have to consider, but all in all, it is looking like a pretty good recovery here. And let's just draw the fib where we are. So we're sitting now with the previous resistance at the 61.8, which is going to be a new level of support on the smaller pullback here, as well as this is exactly the same structure on the larger pullback. Let's just draw our fib, and we can see the 61.8 was a previous resistance, which is going to be acting as a new level of support, which overall does look pretty bullish and really validates the risk on sentiment that we currently see within the market. And this is the small caps, the Russell 2000. This is going to represent more speculative investments. So if the S&P goes up, this usually goes higher for speculative bull market momentum moves. And if the S&P goes down, this usually goes down more aggressively. And we can see that on the 4-hour chart, we got a really big rejection from this previous level of resistance, key level of support, and we can just extend this a little bit further. We can see not perfect, but within the more recent price action, key level of support, new level of resistance, key level of support. Overall, it's looking great for a reversal. We got a higher high to come in from the previous high, so we will see lower lows and lower highs squeezing, and then we saw a push to the upside, pullback, and I think we could see that next move up here. So overall, it's looking like a risk on sentiment. It's looking like it's more bullish for the equities overall, and in my opinion, it does not look super bearish just yet. We got a strong impulsive rebound from that key level of support. Also, quickly looking at the VIX, we did see a move down, so volatility is decreasing. Volatility usually decreases when we're slowly making ground to the upside, and volatility increases when there is a smack down. When asset prices in the equities market are moving to the downside, you see volatility increase. So decreasing volatility means that markets are stabilizing, there's no stress in the markets, and it's probably going to continue to slowly climb up, breaking resistances, holding supports, maybe a little bit of sell-offs, but the buyers are able to come back, pick up the price, and move it higher. Overall, doesn't look very worrying for the global investors as of now. Now, quickly looking at oil and bonds, let's quickly look at oil first. We were able to hold this 34, 36-ish dollar support zone. We did see that we were breaking supports and holding resistances for a little bit, but we could just draw in a nice little bearish little flag here. Not too hard to draw in. We got a series of lower lows and lower highs, but if we just connect the lower highs, we can definitely see that there is a descending channel. You can call it a bull flag. You can see a little bit of a wedge as well, but this is a continuation pattern if we break this descending resistance zone. So in terms of structure, if it breaks the 37, let's say $40 range, it's looking like we could test the highs, if not break the highs and continue the momentum upwards. And we can know oil is, if it's going to the upside, is generally a risk on move. What uses oil? Transportation, more moving, good for an economy. More products that are being made, more plastic, more tires, all the stuff oil is used for. If the prices of oil is going up, if the demand is increasing for oil, that is overall a risk on sentiment. So we see that oil is still continuing to move up. It's holding supports, it's holding resistances. Overall, it's looking bullish. So the risk on sentiment and the optimism of a opening economy is still present. And then looking at the bonds, when yields go up, there is a risk off sentiment. So if you're an investor, this is the way I like to look at it. If there's a bunch of global investors and if bonds are an asset that people are looking to invest in, when the yield goes up, there's more incentive. When the yield goes down, there's less incentive. So right now we're holding a key major level of support. If this holds and the bond yields go up, there's less investors in demand for bonds, because if there's more demand, there's going to be less yield because there's more people wanting to get in. So if the yields of these bonds, 30-year and 10-year, are going to be going up, it means that there's people less attracted to bonds and more attracted to more speculative investments like indexes, like equities, for example, even like oil, right? So that's going to be how I'm going to be viewing bonds in order to assess the risk off or risk on sentiment. I'm not going to be trading bonds, not going to be doing anything like that, but it's a good way to understand where investors are globally. Overall, equities, bonds, oil, it definitely looks like we are in a risk on sentiment, holding that previous support zone, but we do want to be careful. It is pretty key of a zone that we're in right now. We know that we haven't hit a high yet. We're still, even if it holds this zone, we made a lower high if we're looking at the daily chart. Oops, that was the VIX. Let's just go on to the daily chart of the S&P. We do know that we're still making a lower high from the previous high we can see right here, and we want to be a little bit careful. We do not know that there's a key level of support at around 29.80, something to note, but it's not too surprising if we do test this zone again, maybe form a descending triangle, and then if we're able to squeeze out from that to the upside, breaking resistance, that would be a pretty risk on sentiment move in my opinion. But in terms of the shorter term time frames, we see a huge wick on the daily chart. So this is an extremely bullish candle right here. Extremely bullish. Why is that? The price opened here, came all the way down. The bears were trying to test, trying to break the support, but the buyer says, no, we're really going to hold this zone. We're confident that it's going to continue to go up, or we don't mind putting on the size, putting on the risk, injecting capital into the market in order to keep it above this zone. And then in that single day, the price pushed all the way down, but the buyers were able to push it higher than the open, closing really at the top of the range, indicating huge buy pressure in the market. So it makes sense that today's a pretty bullish day. But in terms of overall sentiment, it's looking like it's going to continue to the upside here. We're probably going to get some level of interaction at the 30 to 25-ish range, but we do have a decent amount of room before that goes and hits the next level of resistance. So that's the overall market in a nutshell. Gold and silver are just consolidating. Not too much happening right there. Not really going to talk about it because they're just going sideways. If you are looking to capitalize on any risk on moves, I don't think that gold and silver is going to be the play here. I would say that crypto is looking good. Equities are looking good. If you are looking to short USD, JPY, CHF, and long odd New Zealand, that would be a good opportunity. GBP, JPY might be a good opportunity to long if you are on a risk on sentiment or something like that. So that's going to be the overall structure of if we're on a risk on or risk off. So quickly looking at the questions here before we jump into the crypto market update. But that was the global macro update. I will be going over questions now, so if you have any questions, drop them in the comment section below. I'll quickly go over them. If they're extremely long answered, I will go over them at the end of the video because we will be conducting a crypto market update in this time frame as well. So quickly going to be looking at the questions posted on TikTok and YouTube, although there's no real questions on YouTube, so it'll just be TikTok. All right, getting a little bit of coffee and then good stuff. All right, only bare truth. Any good stock for today or tomorrow? I'm not following the equities market for individual stocks. I am looking at the SPX and Russell 2000, VIX. Overall, I'm looking at the equities and the indexes to understand if we're in a risk on or risk off sentiment, but I am not going to be looking at individual equities. So I'm mainly looking at cryptocurrencies, metals, gold and silver primarily, and then looking at major currency pairs. So That's basically all I'm looking at. I'm not really going into single equities, doing fundamental analysis on them. I have the things that I like to trade. I backtested them. I have strategies, and everyone has different strategies in order to navigate the markets, in order to capitalize on moves to the upside and downside, whatever the case may be. So I can't answer that for you. I do not know of any good stocks that you should buy. U1 jumped to 20. Not really going to look at that one. I'm guessing you made bank today in terms of U1, maybe. I'm not really sure. Do KNet. Let's just continue here. I'm not going to be doing any single stock or single equity analysis. I just don't do that in my personal free time, really. I'd rather trade FX, crypto, and metals. I just really like them a lot more. What about Bitcoin? Huge run up, some 7K to plus 12K. Not sure exactly what time frame you're talking about, but in terms of the run up, yeah, it definitely did have a run up. So in terms of BTC, we will get into it in the crypto market update, but something to note, a lot of people think BTC is like this mystical faraway asset that has no correlation with anything, and it's just not true. We see a high positive correlation between Bitcoin and other risk-on indexes like the Russell 2000 and the S&P 500. It's not like it's a 1-to-1 or a 0.5 correlation, but it's around maybe 0.3 in terms of the shorter time frames, which is still positively correlated. And it's not negatively correlated with stocks and positively correlated with things like the US dollar, Japanese yen, which are risk-off type investments. So in terms of BTC, it's definitely a risk on asset in my view. It's not a currency that is a safe haven. It is a speculative investment. Now, in that said, I do think Bitcoin is one of, if not the best investment you can make due to the fundamentals. Look at the appreciation. Look at how many things that not only Bitcoin but blockchain can solve in so many sectors that we are in today. It's just unbelievable. So I'm extremely bullish on blockchain and bullish on crypto. But in terms of the smaller time frames, we have to look at it objectively and be analytical. We can't just assume that because we love Bitcoin and Bitcoin's so awesome, it'll never go down. We got to look at it objectively. So that's my take on it. Do you think the market will crash soon? By Jim Bros. Right now, it is currently a risk-on environment. Global investors are eating up the dips, buying them back up. So in the short term, it does not look like we are making a massive move to the downside. But the key zone that I'm going to be looking for in order for this to start falling is going to be definitely the S&P 500 key level of support. Now, this is going to be in confluence with stuff like the Russell 2000, which is in a similar situation. But I think to answer your question, is the market going to go down? This is the best on-off, if the market is going to go down or not, indicator in my view. If the S&P is going to drop below this key level of support at around 2970, 2960, I think that's going to be the initiation for the risk-off sentiment move that could be coming into fruition. That's just my personal opinion. If it holds this zone, it's going to be either a consolidation or a risk-on sentiment where we're going to be looking to speculate on moves to the upside on things like crypto, on things like AUD New Zealand, and things like basically those, but we'll see how it goes. We will see how it goes. I can't guarantee anything that's going to continue going up or down, but in the short term, looks like it's holding. It looks like it's continuing to go to the upside, but we are reactionary. We're not saying if A, B, and C happens, the market is guaranteed to do, DEF. Nothing's a guarantee. We are reactionary. We are playing the game of probabilities. That's what trading is. No one can guarantee you anything. If they're guaranteeing you something, they're probably scammers, probably, most likely. We can guarantee that, there's some things that are guarantees, like we can provide the best analysis we can, all that stuff. We can work as hard as we can, but in terms of a profitable trade, there's no guarantees of that. All right, so that is the quick completion of the questions here. I'm now going to go into the crypto market update. But it's mainly going to be just looking at the S&P, equities, risk-on instruments, and saying, how are they looking? Because, like we said before, we think that BTC is a risk-on asset instrument like the Russell 2000. The Russell 2000 is a small cap, yet it's highly correlated with BTC, right? So you gotta take that into consideration. BTC is not on an island that is immune to any sort of price movements anywhere else in the market. It is correlated. So we have to look at the global stage when you're thinking about BTC in terms of where it's going to be going in the short term. So let's just take a quick look at the daily here and assess the current market structure and the price action on the daily chart, because the daily chart is a pretty important chart to look at. In my opinion, it's probably one of the most. So quick understanding of what's happened recently. We've already talked about this before, but we do have an ascending zone, one touch, which is a type A. This is a type B. This is a type B, this is a type A. So we got 4 touches here with an ascending zone creating a nice ascending support. Now we also see a series of lower highs. We see a high here, we see a lower high, we see a lower high, we could see a lower high, but overall we're squeezing because we see a series of lower highs. We know that there's a ton of sell pressure here around the 9.9K zone. There's a ton of sell pressure within this area. So we know that for a fact. Doesn't mean that it's never going to break. It will break eventually, but we know that there's a lot of sell pressure around this zone. And we know that we've been able to hold a series of higher lows. So right now, we are in a squeeze. In a squeeze, we don't do anything. We wait for the price to make a move. If we're entering before a squeeze, we better have a darn good reason why we think it's either going to go up or down. But right now, we don't really definitively have an answer, for me at least. I do not know if it's going to go up or down. My bias is a little bit to the downside in terms of the global macro stage, but in terms of the price action that we're seeing right now, it is looking a little bit like we're going to go to the upside. But we don't want to make a decision too quick. This is just noise. Like, I haven't really been trading BTC or cryptos really recently since that massive move to the upside. A little bit, yes, got to break even, nothing crazy, but we're not seeing any trending movements at all. We saw a little bit of a squeeze here, pushed up, break-even trade potentially if you're able to reduce your risk. But overall, we're not really getting strong pushes either to the upside or downside. So in my personal view, I've just been trading more in the FX and just stationary, because this is just consolidating sideways. Nothing's really trending, and it's not something that I want to be trading. You could be looking for shorts near the top. You could be looking for buys near the bottom, but I just would rather not. I'd rather try to see trending markets that I have a higher percentage trading in. So that's gonna be my view of the daily in terms of the current price action. Give me one moment here. It says it's not really recording. I'm not sure why. Whatever, it's okay. I still have the live, so it's not a problem. So let's just go to the smaller time frames and discuss what we can currently see. I do not know why it was stopped recording, but YouTube's recording, and that's the main thing. All right, so let's take a picture of this and discuss the 6-hour time frame. So this is the lower highs. I just drew a trend line. We're currently at the lower highs right now, and we have this support that did hold on the daily. This was that long wick that held on the daily, but on the 6-hour chart, it was able to hold there. Well, we can see this series of higher lows getting held, and then this series of lower highs. So we're currently in a squeeze right here, and I'm not really going to be doing anything until the squeeze comes to an end and we see some trending action. I don't need to try to make money from like here to here or like here to here. That's just, in my opinion, I don't want to do that. I'd rather wait for the larger pushes and hold. I'm a swing trader. I'm not an intraday, let's just get from here to here, here to here, and here to here. There's no interest for me to scalp on like a 2-minute or 5-minute time frame. It's just not something I like doing. So that's going to be what I'm going to be waiting for, basically. And then on the 1-hour chart, really nothing to be looking at. I'm looking at the larger time frames of the 6-hour to see what we're going to be looking at. But for actionable items, I have nothing really to say. It is just consolidating. It's not super interesting for the markets, and I'm going to be sitting back. I think FX has some better opportunities in the short term because you can play both long side and short side pretty well using the strongest and weakest relative currencies, comparing them together. And then boom, you got a nice pair to work with that has a potential opportunity to be trending for a longer time than a lot of the other instruments that we're looking at. So that's the overall video for the day. Quickly going to be looking at questions. Not really seeing anything. Alexander, good stuff. Thank you very much. Appreciate it. User 977, what is your day job? This is my day job. I am a trader. This is how I make my money, and I currently do not work for anyone, and I don't plan to work for anyone anytime soon. I currently trade for a prop firm as well, but that is unrelated to Performante or cryptocurrencies. I trade in a prop firm that is unrelated to crypto, mainly in the FX market. Well, only in the FX market. But yeah, that is what I do for a job. Is I look at markets and I try to find the highest probable situations that have good dependability, and I implement strict risk parameters in order to basically create as much pips as I possibly can while having very, very limited drawdown. Alright, so I think that's the end of the video. If anyone has any questions, definitely throw them in. But that's going to be the end of the video. Thank you very much for watching. We really appreciate the time. And until next time, have a good one, folks.